And good morning. This is KPFT Houston HD3 channel. We're live from Houston, capital of energy, beautiful Montrose neighborhood. And we're going to talk today once again about energy. But first, a little bit of meditation. Geology. This is Mini Geology, a program about news, curiosities, and debates about the geoscience. So you know, Houston is here, the capital of energy. We have more than 10,000 geologists in the city. The AGI, Association of Geosciences Institute, says that we are more than 60,000 geoscientists in Texas. And the city of Houston says that we have more than 5,000 businesses related to oil and gas. So, we're going to talk today about the oil shocks. And you know, Houston, our city here is dragged by the oil shocks, and it rebounces also when the oil shocks are gone. So it is like a kid in a swing pushed by her father, and swinging until our city will become more mature, so mature enough to diversify its portfolio, like it could happen for a city as mature as Lambda, and we'll see why. So swinging until getting a flu shot. Let's see. Meanwhile, each of the oil shocks, it's a bad flu for our city. So today we're going to talk about these oil shocks, that they affect our economy, with Bill Maloney. Bill Maloney is here with us. He is working as an advisor for a private equity. He's in the Energy Advisory Board for University of Houston. And he has been in Statoil for a long time as the EVP. So today we have here with us Bill Maloney. Good morning, Bill.
Good morning, Daniel.
So here we are. Bill, you know, I'm a pretty inquisitive geologist in here. The very first thing I want our listeners to know is about you, why we're listening to you. We know that you live and breathe through the oil and gas business, including these oil shocks. And I'm very happy that you can describe the oil shocks together with what happened in your life during those oil shocks. But I would like to explain our audience what's the point of view of somebody that has been in a position of executive vice president. By the way, what is in the hierarchy, the executive vice presidents? Where do you place that level?
So, in the company that I worked for, which was Statoil before I retired a little while ago, executive vice presidents, of which there's a handful, report to the CEO of the company. And so, in my job, they split up development and production into three. There was a person in charge of North America. That was me. There was a person in charge of Norway. That was another fellow named Arne Sigva. And then there was a third person in charge for the rest of international. His name was Lars Christian Bacher.
So what do you see at the level of executive vice president that the others, they cannot see in regard to this topic that we're going to tackle today, which are oil shocks?
Well, the nice thing about that job is that you get an overview of the entire company, right? Because all decisions for a major company like Statoil come into the executive committee, of which the executive vice presidents and the CEO are the members. The other part of it is that you get lots of overviews on what's happening in the world, about what supply and demand look like, about how anything to do with climate impacts what we do in producing oil and gas. As you know, Norway is a fairly green country, very, very concerned about climate. Most of the energy is from electricity is produced by hydropower. And so you get a whole broad spectrum across the entire energy business, upstream, downstream, renewables, and then so you get a view, perhaps, that not everyone gets, given the position that you're in. So
now you're going to tell us about your views from up there at the EVP position. What's the difference from the views of a journalist that is investigating on this topic, or from an economist that is reading and doing research on the oil shocks from the economic point of view?
I guess the only difference is, I mean, they're all smart people and they're all reporting what they see, but the difference for me is that people like myself, and then you to a certain extent, right, live this every single day. So we've been in oil fields and in watching things happen in drilling wells, going to outcrops, working with people in labs, and so it's something that we live and breathe every day.
Oh yeah, not only you and me and myself in here, but all of the listeners, main part of the listeners, they are heavily involved with this ups and downs of the economy related to the oil shocks.
Sure.
And by the way, how would you define an oil shock briefly for the listeners that they are there waiting for this topic?
The way I'm going to define the oil shocks, and I'll talk about them just as a prelude for the ones that have happened in my working lifetime. So I'll start in the mid-'80s. But it's where the price of oil, crude oil, drops significantly. And we've seen drops from $30 a barrel to $10 a barrel. We've seen drops from $140 a barrel to $30 a barrel. So and those kinds of things shock the system, right? When you're used to getting a certain price for your product, and all of a sudden that is cut in half or in third, then what do you do?
So before going into the analysis, let me be a little bit more inquisitive.
Okay.
So you are maybe biased to the industry, and who are the other people that can express their opinions about the oil shocks differently than you?
Yes, I am, I would say, biased towards the industry. It's an industry I grew up in from a geology student in graduate school up until as I sit here today. Well, there are others that would see it differently. Sure, if there are people that don't want a carbon in our society at all, that want to see us be completely on renewables rather than any form of carbon, be it natural gas or oil, to form energy and turn the lights on, then they may have a different view of oil shocks than perhaps I do.
All right, so we're here in Houston. Good morning to all Texans, Americans, and I know you are listening from as far as Oxford in UK, Milan in Italy, Buenos Aires in Argentina, Rio de Janeiro in Brazil. Good afternoon, good morning to all of you. We are a KPFT HD3 channel. You can call in the studio and write down the number. We're going to pick up your calls around 7:45, so 40 minutes from now. And the telephone number is 713-526-8737. So call us, and so you may ask questions to Bill here in the house. You can express your own opinions and disagree, and help us forge this new program about geology, one of the very few radio programs that dedicate an entire hour to news, curiosities, and debates of geology. So the telephone number is 713-526-8737. Okay, Bill, so let's go and let's try to analyze these oil shocks, which, in my understanding, there are going to be 4 in your career. Is that right?
That is correct, yeah.
Okay, so where do we start from?
So we start in the middle of the 1980s, and at that point in time, the North Sea was the disruptive play of the day. The North Sea had added approximately 1.5 million barrels of oil between 1980 and 1985. There was an additional 3.8 million barrels a day added outside of OPEC in Alaska, here in the U.S., in Brazil, and in Oman. So 5.3 million barrels coming onto the market in a relatively quick period of time. Well, at that point in time, it didn't sit well with OPEC, and who desired market share. So in November of 2014, in November of that year, in mid-85, they decided not to cut production. Very similar to what we see today.
You said the destructive play was the North Sea. What do you mean by destructive?
Disruptive, excuse me.
Oh, disruptive.
In other words, it was new oil that came to the market, just as at that point in time in the early 80s, Alaska, Brazil, and Oman came on the market. So all of a sudden, you're flush with new oil coming into the market.
Oversupply.
You've got a producer in OPEC that is the low-cost producer in the world, right? And they want to maintain their market share. So one way to take care of that is to keep producing. Your oil is cheaper to produce than someone else's oil is. And so the net effect was that oil dropped from $30 a barrel to $10 a barrel in 8 months. So, and then it took a while to recover. So by 1987, prices were about halfway back. They were somewhere between $15 and $18 a barrel. And so there's a lot of corollaries we'll get to today in a little bit here, but it's very, very similar in some ways to what we're experiencing right now with a market where OPEC wanted market share, prices dropped a great deal, and it is taking quite some time for prices to return.
What did it happen to you during that year, 1985? So
I was a young geologist and first-line supervisor at Shell at that point in time. When I finished graduate school at Syracuse, I came to Houston in 1981 and went to work for Shell. And so it was the first time I saw firsthand job losses, home foreclosures, businesses shut down. It was the downturn in the mid-'80s was really tough on Houston. And you saw it all over the place. And, you see your friends leaving the company. And you're like, well, why does this stuff happen? And I didn't know enough about the energy business at that point in my life to really understand all the ramifications of what happens when the price goes down and what companies need to do to survive.
I really want to listen to you right now because I had exactly the same thought when my soccer team, or I should say the football team where I play every Thursday, was decimated last year because of the oil shock, the very last oil shock. And I lost my entire team, and they had to move away from Houston. So listening to you, what is the next oil shock?
Okay, the next one is in the late 90s, and the cause for that was different than the first. Here, in 1997, OPEC decided to lift quotas that they had imposed on themselves. And the reason they did that is because they had assumed that growth in Asia was going to continue on a very steep trajectory. But what happened at the end of 97 is that the Thai currency collapsed. And this quickly spread to other Asian countries. Now, with demand falling, once again, oil went to $10 a barrel in 1999.
Well, but if demand decreases, the prices should decrease.
Well, demand decreased, but the market was very oversupplied. Because remember, OPEC decided that they weren't going to lift quotas, and so they were going to let all their members produce as much as they cared for. And so when all of a sudden you have too much oil out there, and you've got people that say, well, I don't really need it. My demand is down, so then prices drop. And at that point in time, the marginal barrel, now let me define that. The marginal barrel is the highest cost for an oil producer to achieve about a 10% rate of return. And at that point in time, the marginal barrel was in the North Sea. It was about $10 a barrel, thereabouts. So that really set the floor of oil price. Different than the previous oil drop is that the recovery here was quick. And the reason it was quick is because OPEC reinstated quotas. And all of a sudden, as a result of doing that, you start to bring the market into balance relatively quickly. Now, you asked me earlier about what happens. The same kinds of things happened yet again during this shock. Many companies reduced their budgets. They reduced staff. For myself, I was in London at this point in time, and I'll never ever forget. I got a phone call from my boss saying, Bill, oil's $10 a barrel, and you need to basically cut half the office staff. And after you get over the shock of a phone call like that, and then you realize, and then the corollary was, well, if you don't do that, then we're going to shut the doors completely. And so you do it, and you don't like it. No one likes it on any end of that spectrum. But it is one of the things that happen as a result of these oil shocks.
How did you handle that situation? How many people did you have in your team?
Well, I was at that point in time. I was in charge of exploration in the London office for Texaco. I had left Shell and went to work for Texaco. And oh my goodness, we had probably had a couple of hundred people working in the office at that point in time. And so it was very difficult. We actually closed the office for 2 days and talked to every single person that was in the office. So, no matter whether you were staying or whether you were going or whatever your position was, whether you're being transferred out to somewhere else, we spoke to everyone. And it was trying on all concerned. And so it was tough. And, and I can say the words, but you can't really get the feeling of what it's like to have to experience that. And it's very, very difficult time for everybody. So anyway, the shock, it happened. It came out relatively quickly, but the impact of it was basically the same.
What about the reaction of a big city like London? How did London react to that shock in comparison with the reaction of Houston in the previous shock?
Yeah, it was much different. I mean, obviously it hurts, but the city of London is much more diversified economy. And so that oil is important, but it doesn't represent the lion's share of everything. There's a huge financial business in London. There's a big services business in London, et cetera, et cetera. So the shock wasn't felt, at least as for me, when I was living in London and watching what happened, it wasn't near as what happened in Houston in the early 80s.
And that is because of the diversification that the city of London had with respect to Houston?
That's what I think, yeah, I do. Because there was, it wasn't solely dependent or dominantly dependent upon the energy business to keep its economy going.
And that was the case for Houston.
And in the early mid-'80s, yes, Houston was very dependent upon oil and gas.
Do you think it's still dependent on oil and gas?
No, we'll get to current shock in a second, but you can see it. It still hurts, don't get me wrong, but you can see a difference today driving around the city of Houston in a couple of years into a big price drop, and the effect is as you say, you lost your part of your football team, but the effect is there, but it's not, for me anyway, from observing, it doesn't look near as bad as it was in the middle 1980s.
Okay, so let's move on to the third oil shock.
Yeah, so that was in 2008, 2009, just before the financial crisis, and China in this instance had added 500,000 barrels a day of demand between 2002 and 2007. Total OPEC demand grew by 1.3 million barrels a day. So supply struggled to keep up. So here we have the exact opposite of what I just talked about. So now you've got big demand and not enough supply. Oil hit $147 a barrel in July of 2008. But then suddenly came the global financial crisis, which we won't go into that today, but the net effect of that is that demand quickly collapsed. And so in April of 2009, oil was $50 a barrel. So a huge drop. Now,
so the drop was from 150 to 50? Basically,
yes. And so, but this recovery was V-shaped, if I can put it that way. And the reason, and I'll give you some numbers. So in January of 2010, oil was $75 a barrel. In January of 2011, oil was $100 a barrel. Now, why did that happen?
Why did that happen?
Yeah, because this time OPEC took quite quick action and cut 4.2 million barrels of oil a day between September and December 2008. And given that demand returned in full force by 2010, and then hence, as I said, in 2011, you got oil back up at $100 a barrel. There were a few other things kind of in the background. There were unplanned outages in Libya, in Syria, in Yemen, and Iran for lots of different reasons, mostly geopolitical. But those outages in countries that supply significant barrels of oil to the world also help demand to return a bit, right? Because you're squeezing supply. And in the meantime, in the background, which is what we'll get to in the next one, is North American production started to rise in the onshore of the U.S.
And that is when I arrived to the USA.
Yeah, there you go. So the last one that we'll talk about before we...
Wait a second. What about you? Where were you during that 2008, 2009? Because I was traveling with an airplane from Europe to the U.S. because of the new unconventional revolution. What about you?
So I was... that was my last period as head of exploration for Statoil before I took the North America job. And so Statoil had been through some of these before and realized that, and I, like others, and realized that, cutting exploration would not be the right thing to do in this case, that exploration is something that you can't start and stop like an automobile. That you need, that it's a long-term effort, like running a marathon kind of thing, and so you need to keep it going. So in Statoil, yeah, we cut back on some of the things that we did for sure, and we didn't drill as many wells and things like that. So the capital expenditures, the capex, came down, but there were not massive layoffs. We kept to our guns, to our position that we wanted to keep on exploring. That exploration was an important piece of the total upstream business of the company. And what happened, I mean, a little bit of Statoil stuff, just went out of the financial crisis and into, 2010, 2011, 2012. Statoil then was probably one of the best explorers in the world, finding barrels in all kinds of places, in Norway, of course, but also in Tanzania, in here in the U.S., in Canada.
What about you? What did it happen to your personal life during those years, 2008, 2009?
Well, at the end of 2008, I asked for and received, after some convincing, a sabbatical from Statoil I wasn't paid. I kept my health care, but that was about it. To leave for a period. And so I left for a year and a half. And
1 year and a half.
Yes.
And they kept your position for you?
No, they did not keep my position. There was no guarantees. Oh. So the CEO at the time, Helge Lund, allowed me to, was very gracious and let me leave, but there was no guarantees. So I left. The very first thing I did was my younger son, John, was about to go to university in Melbourne, Australia, and was finishing up his gap year. And so I met him in Nepal for a brief period, and we went. First, we did some work in an orphanage, he and I, and then went hiking in the mountains. And then at the end of that, he went off to university, and I came back to the U.S. And that was the beginning of a long trail of travel and a bit of enjoyment and decompressing from all those years running exploration. And this is a bit of a side story, but I mean, I'll say it anyway. For me personally, Helge Lund and I had three or four, I forget which, conversations. And at the end of that, I thought, well, there's no room for Bill anymore in Statoil. Uh-huh. And I started looking for another job. And then HR started calling, saying, Bill, your agreement's up and it's time to say goodbye. And so I had two possibilities lined up. And so I thought, it's time to say goodbye. So I wrote an email to Helge and a few other people entitled Takk and ha det bra, which means thanks and goodbye in Norwegian. And then the very next day, Helge called and said, well, hold on a minute, Bill. Perhaps you ought to listen to this first. And that's when he said they were considering splitting out North America from the rest of the production and development division, and what I consider being the leader of that in Houston. And obviously I did. I considered quite, and so I came back to Houston in 2010. Helge gave me, it was very nice of him, he gave me a 4-month period to kind of get readjusted to working life. It's kind of like getting in shape again.
So it was a pretty tense sabbatical.
At the end of it, it was, yeah.
And you were pretty bold in taking a sabbatical during an oil shock.
Yeah, but, it was, I was a bit burnt out, I have to admit.
Why were you burned out? What was the main factor that created such a pressure on you?
The travel demands were large. Because I promised to keep my sons in school in the UK for 8 years, I commuted weekly to Norway. Every Monday evening and every Thursday or Friday, I came back to the UK. So
wow, you were a commuter from Norway to UK.
From the UK to Norway, correct. From London to Stavanger mostly, and then to Oslo after the merger with Norsk Hydro. And then, in addition to that, as head of exploration, you got to travel all over the world, right, to all different exotic and exciting places.
Yeah, so that was not the pressure.
No. I mean, the job has pressure in and of itself, right? Because you set goals and objectives. You want to add so many new barrels to the company each year, and you put a lot of weight on your shoulders. And after doing a job like that for 8 years, it kind of gets to you. And so I wanted and needed a break, and I was fortunate enough to get one, and then come back to quite an exciting job.
Even better. So then you move to the U.S., and then you find out after a little while that we have another oil shock.
Yeah. It was, but first I came back, and then that was the period when Statoil entered a big way into the onshore. So there was acquisitions in 2008 in the Marcellus, and then in the Eagle Ford in 2010, and then in the Bakken in 2011.
So you're talking now about the unconventional, because obviously when you arrived to the U.S., we were in this infancy of unconventionals, and the production was already there and was changing the game.
Oh, yeah, absolutely. So then let's get to the last oil shock, and then we can move on from there. So in Thanksgiving of 2014, history kind of repeated itself. And, back in the mid-'80s, I mentioned that the North Sea was the disruptive play of the day. And here, as you quite know, the shale in the U.S. is the disruptive play of the day. And just to put some numbers to that, in 2009, USA onshore production was around 3 million barrels a day. In 2015, onshore USA production was 7.5 million barrels a day. So big difference, adding a lot of oil and gas, but also gas to the market. And so, again, OPEC decided that they wanted market share and made the decision around Thanksgiving of 14 not to cut production. So what we've seen is yet another dramatic drop in oil price. So from around $100 a barrel in July of 2014 to a low of $29 a barrel in January of 2016.
Again, 1/3. It seems that the oil shocks, they produce this kind of numbers. Whatever is the price of oil, it is reduced down to 1/3 of that price.
It has happened more than once. That is certainly true, Daniel. So what happens? Well, it's deja vu, right? Capital budgets get cut, investments get deferred. Exploration sees some fairly substantial cuts. Some companies even cut their dividend, which is a big thing to do, right? Because you're paying your shareholders. And, of course, layoffs. Now, so to put some numbers to this, Woodmac estimated that between 2015 and 2016, in 121 companies, that the average drop was 26% in their CapEx. So,
Can you explain a little bit what is CapEx?
CapEx is capital expenditures. So when you're going to drill wells or put up a new platform, or whatever you're going to spend big money on, that's where your capital budget comes in. And so if you don't spend that capex, then you're likely not drilling as many exploration wells as you thought. You're probably not going to a final investment decision on developing new fields. And so you're reining back all of your expenditures in an effort to maintain profitability. Right? Many big companies want to still pay a dividend to their shareholders. And so how are you going to do that when all of a sudden the price that you get for your product is cut in half or a third? You know, it's difficult. It's not all doom and gloom, I'd say. Even during this period, there has been some shoots of people making discoveries, some oil companies doing new developments, but by and large, we've seen a real pullback in this period in expenditures.
So these are the four main oil shocks.
Correct.
85, 99, 2009, and 2014. So we are going to pick up your calls and questions for Bill Maloney here with me, a former Executive Vice President of Statoil. The telephone number is 713-526-8737. And if you call from abroad, you put that big +1 for United States and 713-526-8737. So, Bill, now four oil shocks, ups and downs, and it seems that the story repeats itself, as you said, more than once. Mm-hmm. Why we don't learn from it? Why the story repeats itself? Why it doesn't change? Or you were just being a course, and if you want to refine your statements, maybe something has changed.
I think as you look forward from today, I don't think we're in the world of a normal commodity cycle change, and I think there are four reasons for that.
What is a commodity cycle?
So a commodity cycle is, you could argue that what I just explained on the four oil shocks are all commodity cycles, where you have a big price drops for one reason or another, and then it comes back. So to a, I'll say, more reasonable or more sustainable level, right, where supply and demand are in unison, which is kind of where it is right now, right? We as a world, we produce 98 million barrels a day, and we consume about the same amount. So when oil comes into balance, then prices usually stabilize. So a commodity cycle is when that goes out of balance, either in a plus or minus sense, and then you get a disruption in price. So many will argue that, okay, we're just living through another commodity cycle in what we see today. And to a certain extent, that is true. I mean, you can't help but understand market forces and know when someone's the low-cost producer. If they decide to produce more to push out someone that costs more to produce, then that's going to happen. However, I think there are a few things where we stand at this moment in the world that say that, well, perhaps there are structural changes to the energy business in addition to normal commodity cycle.
So you think that the next oil shock is going to be different with different effects? And is there going to be another oil shock?
Is it likely to be? Could we go through another cycle? Yes, I think it is likely, but I don't know what it's going to look like.
But why the industry doesn't react differently? Well,
this is kind of my point. I think you're seeing right now the industry doing things in situations that we haven't seen before. So let me explain. So one big change at the moment is that if you look at the big companies, ExxonMobil, Chevron, Royal Dutch Shell, Total, and even my former company, Statoil, the people at the helm, either right now or soon to be, have significant downstream experience. Now, why is that different? Well, the downstream business, which is refining and marketing, has a fairly low margin business, right? It's like running a big supermarket or something like that. You make a lot of money on volume, not on the individual product. And so people that have run those businesses have always had to have a focus on cost cutting, have a relentless drive to improve their business. And so what we will see now with these individuals at the head is that this will be true across all parts of the energy business. It'll be true in the upstream, in the downstream, as well as in anything related to new energy. And so that, for me, that's a difference. It's a different mindset. It's not growth for growth's sake. The people that are running the companies are very concerned about the bottom line and about their returns, which the financial markets always also want, and we'll get to that in a second. So I think that's one factor is why things will be different, because some of these individuals are just in place, right? The gentleman that's going to take over Chevron at the beginning of next year is just coming into his job. And so, and CEOs' tenures are anywhere between 5 and 10 years. So we will see this group of people will have significant influence on what happens in the energy business. Second point on this is cost deflation, and so costs have come way down as a result of the price of oil coming way down. But I think it's also true, you can argue that somewhere in the vicinity of half of this cost deflation is both structural and sustainable. We are improving how we do things. Therefore, are all the people that have left the service sector, are they all going to come back? Probably not. Has the service sector, as well as the companies that use them, found ways to do things quicker, faster, better? Yes, they have. Has digital technology enabled us as an industry to do more? Yes, it has. So I think we're going to see that going forward, we've taken cost out of the business, and that could be sustainable.
So we have an optimization of the chain because of these prices that are so low.
Correct.
We need to become more efficient, and the industries and services, they also try to find the best way to give the same product at lower cost.
Yeah, because they got to make money too, right? And at $40 to $50 a barrel, service companies are struggling.
What else is going to take part in this structural change in the future?
I think you have to talk about climate, and on a lot of different levels. So many oil and gas companies are working towards producing cleaner and greener energy. And I think the world is on a long wavelength path to a low carbon society. So if you look out 2040 and use figures from the IEA or even the EIA and some other companies, today we use 80% hydrocarbons for energy around the world. The projection is 60% hydrocarbons by 2040, and the mix would be 40% renewables and then the rest of it carbon-based, coal, oil, and natural gas. And so that's going to have a huge effect on what we do and how we do it. And even if those projections are wrong, you see so many companies and so many businesses trying to move towards less carbon in the energy mix.
So in a way, this is positive feedback. So you have the society that is, in a way, let's say, protesting in order to affect the role of industry into the climate change. The industry reacts for several reasons. Then because the industry reacts, they are going to produce different products, and that is going to change our lifestyle. So this is the third of those elements that they are changing the energy industry. Well, there's a fourth?
Yeah, and the last one is the financial markets, right? Many of the companies that I've mentioned are publicly traded, and so they have to pay attention to the financial markets. They want people to buy their stock. And the financial markets are pushing for much more capital discipline, wanting further improvement on the returns of a company. You know, if you look historically at some companies, that you get kind of single-digit returns, and people don't like that. They want more in return for what they invest. And so if you look at, we just finished third quarter earnings reporting, And if you look at how oil and gas companies are advertising their ability to be robust at current prices, that only the best projects, especially offshore, are being funded, non-core, non-competitive assets are being sold to others who see better profitability. And so this wave of capital discipline, I don't think is just a passing fad because the price of oil is low. I think it's a structural change where the expectation of people who invest in oil and gas, they want more and better returns, and they want to see the leadership of these companies change how they do things. And then, on the other side of that, there's opportunity for others. So if I'll make up names, so if Shell or Total or Exxon or someone decides, so well, this asset that I have isn't core to me, but maybe someone else sees, well, maybe it is good for me. And so we've seen a few deals recently in the market where smaller companies, some private equity backed, some not, are buying assets from others. A few examples. So Aker BP, Norwegian company, buys all of Hess's North Sea assets in Norway for about $2 billion. There were two deals recently that the company that I work with, Warburg Pincus, did. One in the Bakken to buy a piece of Whiting's assets for $500 million. And then a combine of Cosmos and Trident Energy buying Hess's assets in Equatorial Guinea for $650 million. And then the last one I'll mention is a company named Chrysaor, which buys Shell's North Sea assets, a piece of them, not all of them, for $3.8 billion. So you see the cycle of change here as well. So while the bigger companies are, trying to get more robust, selling things, there are another tier of companies that are taking those assets and are going to try to turn them into something that is profitable.
So this structural change, which is based, according to you, to these four parameters, the new mindset of psychological shift because of the CEOs coming from downstream, the cost coming down, and so improving efficiency, the climate factor that is changing our lifestyle, and the financial markets. These four factors. Do you think that they are affecting industries in North America, in the West in general, or they are going to affect the entire world?
I think it's a global phenomenon. Right, the companies, many companies are global. A lot of the companies that I mentioned with their new or newish CEOs are global in reach. The energy business geology knows no borders, really. And so, where you produce oil and gas is lots of different places around the world. And what you learn in one place, you can apply to another. And so, I don't think it's a local phenomenon. I think it's a global one.
The industries that you mentioned, what we call like the majors, they represent a specific percentage of the entire volume of hydrocarbons that are produced. There are many that are national oil companies, and they probably have a different mindset.
Yeah, they do. But, Saudi Aramco is one of the biggest oil companies in the world, right, which is getting ready next year, possibly, to do an IPO, an initial public offering. And so think about that. If Saudi Aramco does an IPO, and then they're traded on either in New York or London or whatever they decide to do that, then all of a sudden they're working under a different way of thinking. It's no longer just a national oil company that's concerned about the inside. Now suddenly you've got investors, and so you're part of financial markets, and the financial markets, as I mentioned, will put demands on you on efficiency and capital discipline.
I understand that could be an exception, but what about all of the national oil companies in countries like China or Russia, if you will, call them like that? Isn't it Africa?
I see that, but isn't it to their best interest to be more efficient and more capital disciplined, and to produce greener, cleaner energy as well? Because the net result will help their country in a great way. So it's a no-lose situation in my view. If you some of these things that we've talked about, if you do those, whether you're in a national oil company or a publicly traded company, the benefits to you are still there. And if, it will help your population if you're a national oil company in country X, but it will help your shareholders if you're a publicly traded company.
Because sometimes the national oil companies, they don't really are driven by making money. Sometimes it's like a social issue where what they want is like giving jobs, for instance. Mm-hmm. And so that's why I say that they have a different mindset. Now, what you say seems that the Western industries, they are going to become a magnet, and they are going to attract all the other mindsets into this new model. Potentially.
I mean, if one thing I've learned over the years is that sometimes the oil and gas business has a bit of a herd mentality, and that they move in lockstep in some ways. And if this change starts to take hold, then it is quite likely that you could see it affect multiple countries and multiple companies in many different ways.
So, would you want to call us and some questions for Bill or myself at 713-526-8737? I repeat it, 713-526-8737. Bill, can you tell us if these oil shocks are a good thing or a bad thing? Because the oil shocks, they drop the price of the barrel of the oil. But for somebody, it's very good to have a very cheap oil, right?
It is the positive effect towards the consumer is not to be ignored. You can look around this city and other cities in the United States and see cheaper gas at the pump, and that has resulted in, I think Ford sells more F-150s now than they have in the past, and it has a knock-on effect. Now, you could argue this, and some would argue that's a good thing, and some would argue that's a bad thing. But it does help, in many ways, it does help the consumer. It puts more money in their pocket, yours and mine as well. And so there is a positive side to it, but and we focus a lot on the negative side of it.
And we mentioned before the cyclic nature. I don't know if it is right to call it cyclic. So it comes and goes. Mm-hmm. I don't know if the cyclicity has a perfect pace every X years or not. But can you tell us more about why it is cyclic, why, if it is, or why it repeats itself, these oil shocks and rebounds?
It's not cyclic in the sense that you can say, okay, every 5 years or whatever, any certain period that, wow, all of a sudden something's going to hit and then we're going to see a drop in the price of the certain commodity. But in this instance, there's been external factors that have caused it to happen. And, the biggest one is as we mentioned earlier, is either too much demand or too much supply. And that's really difficult to predict. If you look at the world going forward, let me give you some figures. So there's a guy that's done some research from Berenstein's. His name is Oswald Clint, really smart man. And so today, in 2015, the number of cars we have are about 1 billion, 1.1. The projection, according to Oswald, is 2 billion cars in 2040. The number of trucks, heavy-duty trucks in 2015 was 377 million. The projection is 790 million in 2040. Right now, the population of the world, plus minus, is 7.5 billion people, and the projection in 2040 is 9.2 billion people. And then the real GDP of the world is around $69 trillion in circa 2015, and the projection is 164. So we're going to see more cars, more trucks, more people, and the world is going to be a bit more wealthier. Now, are those combined things going to cause another oil shock? Maybe. Is the fact that we have underinvested quite significantly during the period that we're sitting in just now in order for companies to survive, is that going to cause a supply need as we go out into the next decade? That's quite possible as well. So, there's a lot of cause and effect here. As we look forward, besides the four factors about that I mentioned earlier, we have a growing world that's going to want to use more energy. We have an underinvestment that is real and can be quantified, so that there aren't as many new developments. So let me put numbers to that. If today we use anywhere between 97 and 98 million barrels of oil a day, that means we consume about 30 billion barrels a year. Now, the amount of new oil being sanctioned to bring on is a fraction of that, anywhere between 5 and 8 billion barrels relative to the 30. So at some point, you're going to see a drop-off because of underinvestment. Now, is it going to catch up? I don't know.
When you say underinvestment, you mean we don't explore enough to discover new resources?
It's a bit of both. Yeah, it's not enough exploration, right? We've seen, was it last year that we saw the lowest success in exploration that we've seen in 70 years. Not enough new developments coming online. So what you commonly refer to as FIDs, final investment decision, before you go out and develop an oil or gas field. We see some of that. Right, ExxonMobil and Hess are going to develop their discoveries in Guyana. Great fields, wonderful reservoirs, has low break-evens, so things like that still happen. But is there enough of that happening? I don't think so. And so, yes, you can envision that there could be a supply shortfall early in the next decade because of actions that are being taken now. And the actions that are being taken now are quite logical, right? Companies want to survive. They want to keep going. They want to have their employees. They want to produce oil and gas. They want to look towards the future. But they also need to worry about paying the bills today. So that will have a knock-on effect towards the future, as will the change in population. Climate goals are going to have a knock-on effect towards the future. There will be more renewables. I mean, we see that right now. Cost of renewables are coming down, right? It's cheaper for solar panels today than it was 5 or 10 years ago. And so all of this is going to work itself together in a complicated melange to probably cause some disruption in the oil market out in the future. What I can't predict is when that's going to happen, but you can see from my remarks that there are conditions precedent that you can see right in front of your face right now that things are going to change.
Do you think that, would you call it a break point? Or so that the entire system changes, or you see it just as another oil shock?
You can argue that there's a tipping point of where we, as a world, become less and less dependent on carbon sources of energy. But when that happens is difficult to see. Many industry experts will say it's post 2040. And so if you have that kind of longevity in view, then that would argue that, yes, we'll likely see another oil shock sometime before 2040, given the factors that I just mentioned.
So today, with the barrel at 57, do you think we are in a phase of rebounds, so trying to rebalance him?
Yes, I think so. I mean, if you look at what we produce as a world and consume as a world is coming closer into balance as we sit here today. Oil is, you mentioned WTI is around 56, 57. Brent is 63, 64 at the moment. So you are seeing a firming. But you really need, in my view, you need oil to stay plus 60, say 60 to 65, for a period to give companies and investors the comfort to do new developments, especially offshore, because it's difficult. Do you want to risk investing in an offshore platform that you're not going to see a return on for, say, 7 years, when the price of oil has the potential to tank? If you see it as being stable, that would encourage investment.
Who decide the price of oil?
no one person or organization decides the price of oil. Now, you could make an argument that the OPEC cartel has a big influence in that, and they do. When they made the decision not to cut their production but to keep it going, that causes the price of oil around the world to drop, given they're the low-cost producer. And on the opposite side, when OPEC decided to cut, even as recently as right now, I mean, the OPEC countries plus a number of other non-OPEC countries, most importantly including Russia, decided to take 1.8 million barrels of oil off the market within the past year. That has helped balance the market. So if anyone has a big effect, it is indeed a cartel like that, but it's not any one actor. It's a number of actors have to work in unison in order for it to happen to have a big price drop.
And we have to say that OPEC is represent maybe 1/3 of the market.
Correct.
And why you mentioned OPEC and also China? Why they talk nice with the United States?
They talk nice to the United States because the United States is one of the largest users of hydrocarbons in the world, right? We import still oil and not gas, but oil every single day. Now, there's more export happening out of the United States, right? We saw somewhere in the vicinity of 2 million barrels a day or some number like that. I don't know the exact number, but it's large of exports out of the U.S., but we still import. Saudi Arabia has a downstream business here, one of them with Shell. It's called Motiva. And so they bring oil into the United States all the time. So there's, oil's quite fungible. So it moves around a lot. And so there's a relationship between the United States, in China, Russia, Saudi Arabia, where they all need one another because they all rely on the crude that they produce to fuel their nations. And so it's going to continue to happen. Yeah,
but OPEC didn't react the same way during these 4 shocks. Sometimes they decide to stop production. Some other times they didn't. So geopolitics is very important in here, and geopolitics is important for the price of oil, which in turn it affects our lifestyle.
Absolutely.
Yeah. So I see that now we are close to the top of the hour. This is a mini geology radio show where we talk about news, curiosities, and debates. We have in the house Bill Maloney, and we have been talking about shock oils. And here you have some music for you, and I'm gonna mix this because in here we have Led Zeppelin. And this maybe tells you something, Bill. Do you remember this sound?
Absolutely. That's John Bonham, yeah.
What do you know, John Bonham?
I am also a drummer, and have been for feels like most of my life. And in fact, when I was 19, I left university for a 2-year period to work as a musician in New York City. And then at the convincing of my then girlfriend, today wife, went back to school to get a proper education. But I still play drums today, so thanks for that.
Do you still play drums?
Absolutely.
That's important in your life?
It's very important in my life, yeah.
Yeah. And that's all for today. I'm going to leave you. Remind you that we are a KPFT Houston HD3 channel, high definition. This is Mini Geology Radio Show. You can write me at minigeology@gmail.com, and you can visit the website minigeology.com. See you, everybody. Bye.